The Butler Investment Committee consists of 5 people. It's the 3 main board members, myself as the economic advisor, and a consulting actuary, Mike Leeson. The monthly meeting has a similar agenda every month. It starts off with an economic assessment where we look at the outlook for the global economy. And then we move on to financial markets, and we start with a big picture view. We look at the broad allocation between different asset classes, and we look at the geographical distribution of opportunities around the globe. And then we get down to a more microeconomic view. How are the individual funds that we're invested in performing? So it's a matter of having a big picture across asset classes, across geographical locations, and then looking at the individual funds in which we're invested to see whether those funds are delivering the goods in terms of the big picture that we have, and in terms of generating the returns that we want to see across the various risk profiles of the funds that we offer to the clients. Our view for some time has been slightly cautious. I think cautious primarily in equity markets, where we think that the valuations we're seeing, especially in the US market, have gone ahead of the economic fundamentals. That's not to say we're looking for a disaster, but we do think at some stage there could be a correction to the extent that valuations become more consistent with the slow growth environment we're looking for. We've never been that enthusiastic for bonds for some time now. Bonds, in terms of government bonds especially, are offering very poor value in a world where inflation is low, interest rates are low, and real yields have been squeezed. Cash, obviously, as we know, is a fairly uninteresting asset across the board with current levels of yields available at the shorter end of the curve. So we have a view which a risk profile which is more equity friendly as we go towards the higher risk portfolios, but certainly across the board has a slightly cautious bias given our expectation that at some stage we could see something of a setback in equity markets, probably led by a revaluation of expectations in the US.